Today, my guest is James Kandasamy. James is a multifamily syndicator with Achieve Investment Group. He's also the host of the podcast and the YouTube channel, Achieve with the Achieve Group. And he's also an author. And today we're going to speak with him about the benefits of multifamily investing through syndication. But first, a quick reminder, if you like the show, CREPN Radio, please let us know. We would love to hear from you. You can like, you can share, and you can subscribe. Also, want to remind you, if you'd like to see how handsome our guests are, be sure to check out our YouTube channel. That's Commercial Real Estate Pro Network. And with that, I want to welcome my guest, James. Welcome to CREPN Radio.
Hey, Darren, it's awesome to be here. And you have really good voice for a podcast. So I've been in many podcasts, but you have a really good voice, just to compliment
Oh,
you.
well, I appreciate that. That's kind of you to say. Um, Well, before we get going, James, if
Yeah.
you could take a second and share with the listeners a little bit about your background.
Sure. So I'm a multifamily syndicator, used to be an engineer. I think we started with single family homes. We started with 13 single family homes. Now we own up to like 1,300 units in Central Texas, which is basically San Antonio to Austin corridor. And this is where we are buying. We focus a lot on Class B and C workforce housing. And we primarily focus on a lot of value add strategy, which is basically where we can go and reposition the property and put in our expertise, skills, and sweat equity to improve the net operating income and increase the value of the property.
Got it. So, like many, you say you started in single family, but moved to multifamily. Can you describe what it was that appealed to you to move from the single family strategy you started?
It's just a scalability. Single family, there are limitation in terms of number of loans you can get. Like you can go up to like 10 loans with the normal Fannie Mae, rental house programs, right? Beyond that, you have to do a lot of tricks. Like you have to get your wife to get another 10 homes, and then you make it 20, and still you hit still into that wall. And also there's a lot of work in single family, right? You have to manage the single family yourself. I mean, you probably can give it to third party, but then you have to pay them a lot of money to manage it, and just different insurances for each uh, property. I can never find a portfolio insurance. Maybe now that exists, but when I was looking, I could not find. So insurances expire different time of the month because we bought these houses at different time, and we are like scrambling to do the paperwork. Just so painful to do single family insurance. I think taxes are pretty easy. Tenant payments are pretty easy on single family. It's all automated nowadays. But managing the tenants and toilets ourselves, and the insurance is always get get to me because I always there's a lot of paperwork you have to scan, and it runs like a old age industry. There's no DocuSign and all that.
Well, you're making me smile just from a standpoint of that
Mhm.
frustration. It's one that I know too well. As I
Okay.
mentioned to you, I'm an insurance broker, and
Hmm.
often find that insurance companies love to send you a bill and expect payment right away, and what they give you as a clue as to what you're paying on is a policy number. It rarely ever identifies the property address or
Yeah,
any
it's
other.
crazy.
It's like the bill's due now, and this is the account number or the policy number. What's your problem, kind of thing.
Yeah.
And it is a sore spot as far as the insurance industry and their billing methods. I think they could definitely improve upon that.
Yeah.
Um, to answer your question, though, the portfolio type policies, typically, and again, one of the things that I've done with clients in that type of a situation is provide a more of a portfolio policy,
Okay.
and it gives you just that one anniversary date, so you're not constantly, every month or every other week having another bill come in the mail and not knowing which one it goes to, kind of thing. So,
Yeah.
but
Yeah. I don't know. I was looking for it, and I bought all this single family homes at different times. So it's also tricky to like cancel all of them at one and go into portfolio. And at
Right.
that time, I was already giving up on single family. When I had like 10 properties, I said, okay, I'm no more doing single family. I need to go look for something more scalable like multifamily.
Right. No, and I think you are speaking exactly to one of the frustration points,
Hmm.
and just kind of the ease of process. If you have one policy, that's one anniversary date. If you buy, if you were to buy another property in that same entity, or if you had control and you were had another entity that you were controlling, you could add that to another policy depending on how you or your investors choose to do. But that is definitely a benefit of the commercial side of things as opposed to the single family um, investing. Um, so you mentioned that you're doing or that kind of the reason to get into multifamily.
Hmm.
Um, so the markets you're in right now, are you? Did I hear you say earlier that you're primarily there in Texas? Is that
Yeah, I'm in San Antonio and Austin. This is where I'm focusing my acquisitions because we are more of a vertically integrated company. We have our own property management, asset management, and construction management. So we prefer to have it all in one place in our backyard.
no? Makes a lot of sense. And
Hmm.
you're physically there as well.
Yeah, I'm in Austin, Texas.
Okay. Okay. Well, everything I hear about Texas is that everything's big and it's
Everything is big here.
yeah. The only exception I always point out to people is I've never found the on-ramps to be the on-ramps onto the highways being exceptionally big. They seem like about the length of my driveway. It's like get on the freeway. But
Yeah.
anyway, no, I continue to hear about how the business environment in Texas is
Hmm.
pro-business, which attracts
Absolutely.
employers, which makes jobs, which
Hmm.
requires workers, which need housing. So, I mean, there's a pretty straight through line there as far as a demand for housing.
Hmm.
Um,
Yep, absolutely. Like in Austin, there's like 151 people moving to Austin per day.
wow,
Yeah, it's
that's
crazy, right?
that's great.
That's
That's
great.
great.
Yeah, yeah. Austin and San Antonio and even Dallas, I think there's like hundreds of people moving per day to the city
Wow.
from the East and West Coast and other states as well.
And is there a particular industry that's driving? I mean, are there? I'm assuming those types of cities are pretty. What is the population for Austin?
Austin is like almost a million people. I think San Antonio is like around another 1.5. Dallas itself is, I think just the Dallas is just 2 million, but the Dallas MSA, right, is huge. I think it's like 4 to 5 million. I think I don't have the exact number on Dallas because I don't really look at there so much, but it is huge cities. And I think it's just the business friendliness, the low tax. I mean, your property tax is higher, but there is no state tax, and the houses are cheaper. Living cost is cheaper here. So a lot of people from the coastal city move here. Um, and like Austin in general, there's a lot of tech company coming here. There's a lot of startups coming here. So it's creating this very young crowd. It's one of the youngest city. I mean, not say youngest in terms of city, but the the millennials. There's
Population.
so much of millennials living here just because of the tech startup culture and the companies that are moving here. Whereas San Antonio is more of a healthcare, medical. I mean, healthcare and military and other diverse industry in that MSA.
Gotcha. And the distance between them, is it an hour's drive or
Yeah, it's like 100 miles between Austin and San Antonio. I mean, if you go to South Austin and North San Antonio, it's probably like what, maybe like 80 miles, I guess.
Gotcha. Gotcha. All right. And you said you mentioned the number of units you currently have. Was it 1,300? Was that
Yeah,
approximately?
1,300. Yes.
Okay. And all of those are through syndication. Is that correct?
Yeah, all through syndications, correct.
Okay. And when you are looking for a property,
Hmm.
um, and you mentioned that you guys do value add,
Hmm.
is there any kind of a recipe that you guys look for, or is there kind of formula? And I don't like getting your secret sauce, but I'm just kind of
Mhm,
curious on a value add. Can you describe what you guys are looking for, or what you
mhm.
see?
Yeah, I mean, there's no secrets, right? So what we look for is basically mismanagement, right? And two things. One is mismanagement, which controls the expenses, right? Whenever you see this third-party company comes in, the expenses are usually very high. Um, so we can, because we have our own company, property management company, we can go and bring that back to the standard industry standard. Like, let's say 60%. Other companies, when we go in, we can bring it down to 50 to 52%. So that is one value add that we do. The second value add is by improving the interiors or exterior of the property, we can increase the rent in that property, making it much more desirable for a much more higher paying tenant base, which means we can increase the income. So when you do the income and the expense, you can get a much better net operating income, right, which increases the value and gives our investors much more leverage in terms of getting higher returns.
Got it. Now you mentioned the mismanagement.
Mhm.
Um, is that primarily just the fact that somebody's using a third-party manager? Is that the easy tell for you that there's an opportunity, or is there like some line items that you typically identify that are out of out of round?
Oh, we have to go line by line item and see what's happening in that property. There could be some line item which is a valid line item based on the property needs. But in general, you'll see, standard industry standard line item for expenses are like 50% or 50 to 55% of the operating income. And when we see that line item going above like 60, 70%, then we know it's a big opportunity for us to go and reduce
That's when
the
you get a little
expense.
excited. It's like, oh boy,
Yes,
opportunity.
yes. Correct. But the thing is, the sellers usually, sometimes they don't give you that buffer or that upside to you. They may want you to pay, some of it to them.
Right, right. um, so in the multifamily, you said you
Uh-huh,
guys are going after
uh-huh,
B, C properties.
uh-huh.
Is there a particular number of units that you guys stay one side of, or is there?
We try to go above 100 units. Most of the time, we try to look for like 200 units and above. You know, to make sure the scale is, makes sense in terms of operation, like payroll and just payroll and having a more on-site staff that can be supported by that property. It's very important.
Right. So when you are in the, working for or to find a deal, I mean, there's a lot of moving parts. You've got
Uh-huh,
the sourcing the deal,
uh-huh,
um, negotiating the deal, financing the deal, your value add execution.
uh-huh.
Um, is there? Do you find that any one of those is more important or for your success?
I think two things, right? One, you have to buy it right? So you have to have an upside when you buy, right? You should never buy it on a deal without upside and hoping that appreciation will take you somewhere, right? So you buy a deal with proven upside. That means the rents are lower than the competitors, or the expenses are too high. So we know there's upside there. So that's one thing. But I think the bigger money nowadays to be made, especially at this market cycle, is on the operation, right? If you can operate it much more efficiently than everybody else, you can basically get a lot more returns to the investors, right? And you can make deals make sense.
And do you find that just like you mentioned the bringing that in house is where you're able to really fine tune that, or is it?
To Well, not really. In-house makes it better. It does make it better, but the control of in-house is a lot more valuable, I would say. I can call someone in the property and either fire a property manager or a leasing agent, or I can reduce staff myself, right? If I have a third party, then you have another layer to talk to, right? You have to justify to another person. So that is the biggest bang for the buck by having your own team in property management, especially in a value add acquisition and repositioning, because there's a lot of work that you need to put in to make sure that the property really turn in terms of repositioning.
So I get the um, the importance or the value that you're able to provide by
Uh-huh.
having it in-house and stuff. But I'm kind of curious, since prior to getting into multifamily, you were doing single family. Were you managing those yourself?
Yeah. Yes, we are
Okay.
managing it ourselves. But single family is a slightly different tenant base, right? So
Oh
usually
yeah.
they are much more, on a higher pay range because they're paying much more higher compared to people who live in apartments, right? So the management of them is slightly better than people who live in the apartments, especially
Right.
on class B and C workforce housing.
Right. So with the moving to the multifamily, and now you have the management in house. Did you always have the management in house, or did you outsource it originally, or how'd you?
No, we started managing it all the time by ourselves. We just said we're going to bite the bullet and start doing property management from the beginning.
Okay. So you probably got some interesting lessons you've learned over the time. Is there anyone that stands out in the beginning that was a never do that again, or always do this, or
Oh, I mean, in terms of tenant management, residence management.
yeah,
Oh, there's many things, right? We see all kind of things, which is we are learning every day, right? But some of the biggest thing is you are training your tenant to be complying to your policies and procedures. So I think it's very important that you put your foot down and make sure that your property manager train the whole tenant base to pay on time. That means charging late fees on time, doing evictions on time. If there's a lockout, they have to do it on time. So they have to follow very strictly, right? So that the tenant base would really know that you mean business and you are doing what you're saying, right? The problem is sometimes the property managers can be more friendly because sometimes when people say cannot pay, there can be a lot of stories behind it, which can be valid. But as a business owner, you have to be very careful about not giving them the leverage because you also hit into fair housing law, right? You can't say this person I can give leverage and the other person I can't give leverage, right? So following the fair housing law at the same time implementing the policies and procedure, and getting your tenants trained on your policies and procedures just by paying on time, being a good tenant in the community is an important step that I think any property management company should do.
yeah, no, amen to that. I've learned that firsthand. We have a couple we still manage some single family, and you know, um, if you're not watching it, they'll train you in a hurry how things are, and then you're constantly trying to play catch up, and once things get kind of loose, it's tough to bring them back in the round.
It's very difficult, yeah.
Yeah, yeah. So,
Right. So yeah.
all right. So now that you're syndicating
Uh-huh.
your multifamily properties, um, I presume you're raising capital from investors to
Uh-huh.
participate in deals, correct?
Yes, I do.
Okay.
Yeah, we raise money from private investors.
All right. So when you're speaking with investors,
Uh-huh.
what are some of the key reasons that they're looking to get to invest in multifamily?
I think key reasons most of the time in syndication is basically, they want to park their money and make money. But I think the biggest key reason would be they want to park their money and make money with someone they can trust, right? That's the whole point about syndication, right? I mean, experienced passive investors knows that it's not every real estate syndication real estate investment package they get is not the same, right? So they have to make sure they park it with the right person, right? Because you're passive investment, right? You're giving it to someone else to manage the investment, and so that's the reason why people invest in syndication. I mean, first is of course to get the returns that a real estate gives, on plus the tax benefit. But I think doing it on a syndication fashion on a private model with someone is basically giving them their trust as well to that person.
So let me ask you,
Hmm.
having said that, and someone you can trust, are there anything or any tells, if you will, that you recommend investors who are looking to invest passively that they be on the lookout for, or some things to be aware of?
Yeah, absolutely. I mean, I wrote a book for passive investors. I mean, my book right now on Amazon is called Passive Investing in Commercial Real Estate. And it talks about from passive investor perspective on how you want to think, right? So it's not like talking about how to buy an apartment complex, how to buy this real estate deal, but it talks a lot about what kind of deals that you want to invest in passively, right? How do you select a deal sponsor, right? How do you select the timing of the market, right? What are the different metrics that comes about from this passive investment? When someone tell you 10% cash flow, what does it really mean, right? How do you vet a sponsor, right? What kind of cash that you can use to invest? Do you use a self-directed IRA, or use a cash, or you use your 401k, or use something called a QRP or solo 401k? So there's many different sources of cash that they can put to invest in this deal. So this is all I talked about in my book, and I would recommend anybody to go and get that book.
And what was the title again? Passive Investing
It's
in Commercial Real Estate?
Yes, it's called Passive Investing in Commercial Real Estate: Insider Secrets to Financial Independence. And I have it in Audible version and physical book version as well. So you can listen or read the book.
All right. Well, I'll be sure to list that in the show notes. I appreciate you pointing
Sure,
that out there, because
sure.
that's
It's in Amazon and Audible, so should be easily accessible.
got it. And you mentioned the cash flow or tax benefits.
Mm-hmm,
When you're meeting with a potential investor,
mm-hmm.
are there any particular tax benefits that you point to, or is it?
So there's two types of investors. One is where they are more involved in real estate. They may have a rental, they may be a broker, they may be agent who want to invest passively. So people like that are usually categorized under real estate professionals, right? So in commercial real estate or any real estate, you have something called syndication, right? So what happened is we divide, either by 27.5 for commercial, actually for commercial and residential is 27.5 of the value of that building, and then you minus it off from your income, right? So for real estate professional, they can minus off entire depreciation as part of the active income, which is a huge benefit, right? Right. So, but people who are not real estate professionals, these are like people who are not in real estate itself. This can be doctors, lawyers, engineers, anybody, right? Not only professionals, anybody else who are not in real estate. They're busy working with their own job. So the way we should explain, or the way they make the tax benefit that they get, is something I call a magical box of tax conversion. Right? So let me explain what is that magical box of tax conversion, right? So let's say someone at a 30% tax bracket, right? I mean, the maximum is 37%, right? So someone, we're just taking some average person. When they invest in real estate, especially in commercial real estate, what happened is this magical tax bracket converts that 30% to like 20 to 22%, right? And this is how the magic happens, right? Because there's no secret sauce, as I told you in the beginning. The magic happens is the tax world and the cash flow world is two different world, right? So cash flow world, you may be getting 10% cash flow, but in the tax world, the way the accountants count, that 10%, when you that 10%, even though it's a positive income from the investment, your depreciation is going to say that, oh, I'm going to minus off the building value, which is decreasing, which is depreciating on the paper, and that 10% become loss. It's going to be, you're going to be having a loss of negative 2%, because now you have 12% depreciation coming. So basically that 10% is protected, or is basically tax deferred, right? But what also happens is basically you also minusing off from the cash flow in the tax world, what the accountant do, which is based on the tax code itself, what they're doing is they're also minusing off the mortgage interest, right? And they're also minusing off the mortgage loan cost. So there's three factors. One is depreciation. Second is the mortgage interest and the loan cost itself. So whatever points that we pay on the loan, whatever cost that takes to do the loan is going to be minus off. So when you minus off these three things, but when you sell, so every year you are minusing off these three things. So in the tax world, it is showing as a loss, right? But when you sell, you're going to recapture back that depreciation specifically, right? And some of the amortization of the loan cost, right? The interest doesn't get recaptured again. But the thing is, even though we are depreciating 100% every year as a depreciation, saying that you're losing money on paper, but when you sell, you're not really capturing back 100%. You are recapturing only 25% of whatever you depreciated before that, right? So even though you depreciated 100,000 for past 5 years, when you sell, the tax code say you're only going to recapture 25,000 of that, right? So if you do the numbers right, so this magical tax bracket conversion happens to convert that your active income, because your active income you're putting is an investment into this real estate investment, right? But when you sell, when you look at your active income, you're actually paying much lower taxes because you're recapturing it lower. So when you do the calculation, your 30% would become 22% tax bracket. So this is what I call the magical tax bracket conversion.
Actually, that's one of the most clear and easiest explanations I've heard for the magical tax bracket there, the tax box. I like that.
Yeah, absolutely.
But that just that not having to pay tax on the income you're getting from the real estate because of the depreciation, but then how you explain that the recapture thing there, I thought that was appreciate you explaining that.
Yes, correct. And if you look at it, right, let me explain one more thing. So from 30% to, let's say, your tax depreciate to 20%, right? So that's probably what when you do something called when you divide that 20%, when you are basically getting a 10% reduction, right? So 10% on top of 30%, you're getting basically a 30% tax reduction compared
Right.
to getting active income and using it on a day-to-day basis, right? So so basically that magical tax bracket would have given you 30% tax reduction just by investing, right? And this applies to passive investors who are not in any real estate investment. Just investing itself, you get all this benefit. And the tax code is written to incentivize real estate investment, right? The government can't really take care of houses, right? If you go to like any other country, a lot of third world country, the government takes care of housing of that country itself. Like if you go to Singapore, there's a lot of housing that's being given and built by the housing, right? But in the US, I think the government has chosen not to do that. They want the private sector to handle the housing part of it. And people like us who are managing, buying these deals and managing housing. So what has happened is that government have made the tax code to be really incentivize real estate investors who are taking the burden of giving housing to people, but the way they're paying these people is by giving them tax benefits.
Tax incentive, yeah. Nope, I agree, and I think the notion there is that there's benefits in ownership. Period. Obviously you build equity and stuff. And I think that just from a standpoint of, it's also you think about how much the economy is centered around real estate. From the
Absolutely.
standpoint of the transaction, from the buy and the sell, you've got all the different people that participate in the transaction. The lender, the broker, title, attorneys. On and on and on. And I just, it's hard for me to see how much could change. They're always tinkering with something to try and change behavior, and that's basically what it is. But no, I think that by and large, the U.S. Tax code favors real estate. So I agree.
Yes. Yeah. Real estate is the only investment that you can buy, 20% below value. and you can get a 80% loan, and you can also increase it above 100% value, right? So it's very powerful.
Yeah, no, the power of leverage is really. I mean, when you see it from a real estate investment like we're talking about, especially one that you can force the appreciation,
Hmm.
it
Absolutely.
truly is that you see the power of leverage. Whereas if it's just something you're buying and you're waiting until it gets paid off,
Hmm.
that's, I mean, yeah, you're acquiring an asset, but when you add that the ability to improve the value, it's truly a multiplier that it's unlike any other investment I know. So,
Absolutely.
um, hey, on I got a one more question, then
Sure.
got another one after that. But um, can you talk about your most recent acquisition? What was the property, number of units in your plan?
So we bought two properties, which totals up like 370 units. One of it in Austin, and the other one was in San Antonio. I think both of it came up to like almost $30 million deal.
30 or 13?
30.
Okay.
Yeah, I mean two of it together. Yes.
Wow. And what's the strategy with that? Is there value add plays or
Yeah, yes, correct. Both are value add. I mean, the one we bought in San Antonio was had by the same owner for past 20 something years. So yeah, that's really definitely a value add. The one in Austin, I mean, the same owner had it for like 3 or 4 years, but it's just that whole area is gentrifying, and we see a clear upside in terms of rents, and that's where we went and bought that property as well. So it's and the Austin one is more of an interior upgrade and changing management, whereas the San Antonio one is a similar thing. It's just changing management and interior upgrades, and we may do some exterior as well.
no? That's great. And when did you close on those?
We closed it on February 1st, 2019.
Gotcha. And do you typically hold, or what's your hold period?
We
What do you like?
we plan for like 5 years. I mean, we will review our plan every year, but we tell our investors 5-year plan, and it's just we just slowly, continuously manage the property to whatever pro forma that we are trying to hit.
Got it. Got it. James, if I could, I'd like to shift gears here just a bit.
Sure.
Um, Before we started recording, I mentioned you that by day I'm an insurance broker and try and work with real estate investors primarily. And when working with our clients, we do risk management. And there's typically there's three different strategies we tend to employ. And the first would be avoid the risk if it doesn't make sense. Um, Two, can we minimize the risk? And then the third option is transfer the risk, and that's where an insurance policy comes in. That's exactly what an insurance policy is you're transferring the risk from you to the insurance company in exchange for the premium that they're going to charge you. And so lately, I've been asking my guests if they could, take a look in their, world of real estate investing and identify what they consider to be the biggest risk. And just to be clear, I want to make sure I'm not necessarily looking for an insurance related risk. Although if that is the case, so be it. But I just want you to know that I'm not necessarily limiting this to, something along those lines. But with that, I'd like to ask you, James Kandasamy, what is the biggest risk?
I think the biggest risk is not doing due diligence properly, either on the physical property inspection or even on the business plan, right? To make sure your business plan is correct. Because when you buy a deal, we always have to make sure that we understand everything about the deal, right? Because we're buying multi-million-dollar deal. Now we are syndicating. We have passive investors' money in the line. Our money is on the line, and we want to make sure that we do as much due diligence as possible. Um, So the biggest reason always that I fear is always like, did I miss out something? So I'm always checking and checking and checking, double checking, triple checking, and making sure that I know everything that I do. And a lot of times this is being mitigated by our lender, because we usually get like Fannie or Freddie, and they do another round of checking, they do another round of underwriting, and they do another round of inspection on top of we are doing, right? But there's also risk when you go and take other smaller loans, right? Community bank loans or normal loans, because they are not as strict as what the agencies are, and because they're not being strict, they may skip out things, and we as the sponsor may be stuck with something that should have done it. I mean, you are alone in that case, right? When the lenders are not doing their due diligence, you are alone. So I think people who have, non-agencies loan, or lender which doesn't really stress on the inspection side of it, you want to be very, very careful, and you want to do double, triple check on your own, because you can end up with a big loss if you found something that you didn't expect, right?
No, I appreciate you sharing that, because I will, I'm in that choir, due diligence. I, you know, I know just in one of the properties we have, there's some things that I've recognized that I do differently, and I think that one of the go-to topics I think that I find with investors, period, is just that making making certain that the due diligence that you've looked that property inside out, upside down, forwards and backwards, and you know where the skeletons are before you end up the owner, kind of thing. So
Correct,
and
correct, correct.
and also with that, establishing a capital budget
Hmm.
to address
Hmm.
it,
Yes.
because
Yep.
otherwise I think that's the real downside, that
Hmm.
if you fail to do that and you own the property, guess what? You get to fix it.
Hmm.
And if you've already closed and the seller's got his money, he's not going to come back and say, "Oh gosh, you're right. I should have."
Well, not only closing, right? Nowadays, if you see a lot of deals in the hot markets, there's day one hard money, right? And people are putting hundreds of thousands of hard money day one, right? And they start doing due diligence. I mean, either they do before they go under contract, or they do after, right? But usually lenders who does a lot more thorough inspection, they come in after you go under contract, right? And let's say they found something big, now the sponsor is stuck, right? So I have had day one hard money, I can't get out of this deal, and I found something big. And usually the sellers they are off the hook, right? They know this guy can't go anywhere, right? You have big hard money, you have like 300, 400,000 of hard money, and where are they going to go? So the sponsors are forced to close, right? And that can be a big danger, right? Because now you have made a decision to go ahead, even though there's a big risk, right? And you know it's just what's happening right now in the market. So you have to be very, very careful about trying to get as much inspection before your hard money goes hard, really. And that's what I do now. I try to do everything even before I go under contract. I try to mitigate all my risk before my money becomes hard. So try as much as possible to mitigate the risk in this hot market while trying to do deals is one of the biggest challenges nowadays.
Got it. No, I appreciate you sharing that, and like I said, I concur wholeheartedly. James, before we wrap up, where can the listeners go if they would like to learn more or connect with you?
My email is james@achieveinvestmentgroup.com. Like achieve means like achieving a goal, ACHIEVE. So my website is achieveinvestmentgroup.com. Email is james@achieveinvestmentgroup.com. You can get me in Facebook. I have a group called Multifamily Investors Group. That's like 2,200 people inside there right now. And also in LinkedIn, James Kandasamy. And I have a book out there on Amazon, as I mentioned just now. And also I have my own podcast called Achieve Wealth Through Value Add Real Estate Investing. We talk to a lot of operators on how they do things, and we have like 3,000 downloads right now after 15 episodes. So yeah, these are the places that you can get hold of me.
Well, that's great. And I'll be sure to list all of that in the show notes. And James, I just want to say thanks for taking the time today. I've enjoyed it, learned a lot, and hope we can do it again soon.
Absolutely. I mean, I'm happy to add value to you and to your listeners.
Well,
Thank you.
and today has been an exceptional. I love the fact you know what you've gone into today has been very beneficial. And I thank you for that.
Oh, absolutely.
All right, for our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.